Welcome to the channel JIV and CIV Made Simple. In this particular video, we are going to discuss our CCP Certified Credit Professional Unit number 5 as per our Taxman reference book. The chapter name is Credit Appraisal. These are the topic which we are going to study. First of all, objectives. Then you will see the introductions, credit appraisal, validation of proposal, cardinal principle of lending, creditworthiness of borrower, purpose of the loan, source of repayment, cash accrual and collateral. Every topic will be made clear in this format. First of all, we will see the definition, key ideas, formulas and rules, one line example followed by MCQs. So this way we will cover the entire unit. So if you have not seen our earlier lecture, check out the description section. We have provided you earlier lecture. Please go through them. So let's get started. So ever wondered how bank decide whether to give you a loan or not? It is not a magic. It is called, this process is called credit appraisal. Right. So let's break it down in the simplest way possible. So basically it is a safety check by the bank before lending the money. Right. So they want to know, is your project technically feasible possible, and is it economically profitable, and most importantly, can you repay the loan? Creditworthiness. Think of it like a background check for your business idea. So bank look at 8P. What are the 8P? First of all, risk involved. Second is people behind the project. Who are the people behind the project? Third is the process you follow. Fourth is the product delivered, market prospect, future projection, anticipated profits, expected profit, and how you plan to repay, proposed repayment. So the rule is that creditworthiness is equal to feasibility plus viability plus risk assessment. So combine feasibility with viability plus risk assessment. That will be your creditworthiness. For example, if you ask for a loan, the bank check if your business can actually make enough profit to pay them back. That is what the bank check. If a business project can repay the loan based on profit projection. Now, what are the steps in credit appraisal? Let's have a look. The steps in credit appraisal. Once the bank decide to check up your creditworthiness, this is the 5-step process, right? So for creditworthiness, 5-step process. First of all, processing. Processing means your application is reviewed, then sanction, your loan get approved, documentation, all legal paper are signed, disbursement, money is given to you, and monitoring. Bank keeps an eye on how you use the money. So the memory trick is PSDDM, right? Which means, processing, sanction, documentation, disbursement, and monitoring. So loan move from application to monitoring after disbursement, right? So the master tips is that you can think of credit appraisal as a 5-step safety check before giving the money, right? So this is a 5-step safety check. So this is the formula flashcard. Have a look. The first formula is that, creditworthiness include feasibility, viability plus risk. 3 things are there: feasibility, viability, and risk. Second thing, credit appraisal is the 5 steps: processing, sanction, documentation, disbursement, and monitoring. Right. Now let's apply the concept to some MCQs. Which of the following is not a part of the credit appraisal step? Processing is a part, sanction is a part, marketing is not a part, monitoring is a part. Next question. Which credit appraisal primarily assess what? Borrower repayment capacity, bank profit margin, competitor market access, and government policy. Actually, it assesses the borrower repayment capacity. So friends, next time whenever you hear this word credit appraisal, just remember it is the bank way of making sure that their money is safe. This is the bank way of making sure that. Now, let's shift our focus to the objective of the credit appraisal. Yes. So now have a look at what are the credit appraisal process. So friends, credit appraisal starts with, ever wondered what happened after you walk into your bank for a loan? So credit appraisal is not a one-time step. It is a continuous process. It starts the moment you enter the branch and end when the loan is delivered. What happened in the process? See, bank verify your detail like KYC and financial documents. So bank verify your KYC detail, bank verify your, your financial document, bank measure the risk, they do the assessment of the risk, and they finally decide whether to sanction the loan or whether to reject the proposal. So the formula is very simple. They do the verification, they do the risk. What does the risk in credit appraisal means? So whenever a bank checks a loan request, It does not just look at the document. Basically, bank try to understand that how risky is the loan. That's called, risk in credit appraisal. So how risky is loan? That is what the bank looks at. In simple word, we can say that is the person reliable, right? They check whether the person is reliable, is the information true, right? And will the project actually work? So three things I'm talking about. Applicant means person reliability, information means information true, and whether the project will actually work. So this whole process of judging the risk in a loan proposal. So this whole process of what, judging the risk judgment, right, in the loan proposal is what we call, risk in credit appraisal. So from guesswork to database decision. So earlier, loan decision depends on lot on the officer personal judgment. So there was subjective judgment of the officer, but today, everything is data driven. Everything is data driven. That's the peculiarity, right? So bank use some proper tools like, credit rating, like, financial analysis. So credit rating tells us how trustworthy the borrower is. Financial analysis, you check balance sheet, profit, cash flow. Working capital assessment, does the business have enough day-to-day fund? So these are some, tool metrics that the tools that the bank use. Now the decision has become objective, not emotional. Earlier it was subjective judgment. Now it has become objective judgment based on credit rating, financial analysis, and working capital assessment. So the easy formula to remember is that, risk appraisal is now objective measures, credit rating, financial analysis, working capital assessment. In short, you look at the rating, study finance, check working capital. That's how you decide. For example, a loan officer is reviewing a business loan. He check the company credit rating. He studies their financial statement. He calculate their working capital need. This helps them judge how risky the loan is. So the master tip is that, modern credit appraisal, it includes risk-based, objective, and data-driven. Three things are there: risk-based, objective, and data-driven. So let's have a look at the key rules and key formulas that we have gone through. So credit appraisal means verification plus risk assessment plus decision. And then risk appraisal, credit rating, financial analysis, and working capital assessment. Right. So verify, risk assess, and decide. And risk appraisal, credit rating, financial analysis, and working capital assessment. So these two are different things. Now let's look at some questions. The first question is, credit appraisal process begins when loan is disbursed, applicant enter branch. Exactly. Right. Yes, when the applicant walk into a branch and continue till the credit delivery. Modern credit appraisal focus on subjective judgment, objective risk assessment, marketing strategy, customer relationship. Modern credit appraisal focus on objective risk assessment. Option number B is the correct answer. It focus only on, objective risk assessment. Now friends, the next concept that we have is called due diligence. So friends, before going to the next concept, let me tell you that for CEO's mock test of CCP at one place, our CCP comprehensive program is right there for you, which is all inclusive, provide everything at one place. You can get such kind of PDF, videos, explanations, MCQs, more than 2000 plus MCQs are there to check your understanding. And moreover, we provide mock test and quizzes also. Per unit, there are 3 to 4 mock tests, each consisting of 20 MCQs. So through this entire the course, you can have a command over the entire CCP subject and clear the paper in the very first attempt itself. So for more detail, you can get more detail by WhatsApping me on this particular number or check out the description section of the video. Now friends, let's talk about the CDD. CDD is due diligence. So it's a very important step in the credit appraisal. So what is due diligence? So either you call it customer due diligence or you call it due diligence. It is basically, bank way of making sure that who is the customer. That's called, identifying. Identifying means who is the customer. Is this person genuine? That's called verifying the customer. And is the money clean? Right. So three things are there. First of all, who the customer is. The first question. Second thing is the person genuine? That means, verifying the customer. And is the money clean? Right. So these are the three questions that the CDD answer. So the bank verify the customer and the real beneficial owner to protect itself from some risk. So bank verify the customer, bank verify the beneficial owner. Why? To mitigate some kind of risk. What kind of risk is mitigated? Like money laundering, like terrorism financing, like other illicit activities. So these are the, these are the risk from which bank, mitigate itself by using the CDD, customer due diligence. So what is the key idea? In simple word, we can say that, CDD means you check the identity, you make sure that customer is trustworthy. Now, what does the CDD includes? CDD is not just about collecting documents. It's about, verifying identity. It's about, identifying the customer. It's all about, checking their business activity, continuously monitoring their transaction for red flag, monitoring for red flag, business activity information, financial information. So all these things are under the CDD. So the simple formula is, due diligence includes three things: identification, verification, and monitoring. Right? Identify, then verify, and then monitor. These are the three things under CDD. So one example I can give you. For example, a bank examine the customer ID, PAN card, business proof, continuously monitor their transaction to ensure that nothing suspicious will happen. So that is what happened under the CDD. Now let's talk about the types of due diligence. So bank don't check customer in one way. They use three different type of due diligence during the credit appraisal. What are the three different types? The first type is called, financial due diligence. So what happened here, they check the financial health of the customer or the business. So checking of the financial health of the customer or the business, that happened in the financial due diligence. Are the number correct? Are they profitable? Or do they have much debt? All these things are just under the financial due diligence. Second type of due diligence we have is called commercial due diligence. So this check the business model, this check the viability. So two things are being checked: business model and viability. Right? So is the business idea practical? Will it survive in the market? That's called commercial due diligence. And the third kind of due diligence we have is called legal due diligence, which means all the legal document, all the compliance. So are the licenses valid? Are any legal dispute? Is everything legally clean? So that is checked under legally due diligence. So the formula and rule is that, there are three kinds of due diligence. One is financial, other is commercial, and third is legal. So let me give you one example to make it more clear. So before giving a loan, the banks check the company financial statements, the bank studies its business prospect, the bank confirm the legal compliance, and then it sanctions the loan. I hope it is crystal clear. So CDD includes two things. First thing is know your customer. Second thing is monitor continuously. Know your customer plus monitor continuously, that is CDD. So the rule is that, due diligence includes identification plus verification plus monitoring. Just now I told you. First identify the customer, then verify their detail and keep monitoring their activity. Second type I told you, financial, commercial, and legal. These are the three pillars of due diligence. Right? FCL, financial, commercial, and legal. Now let's have a question. Look at the question. The question is, which of the following is not a type of due diligence? Financial, commercial, legal, marketing. See, marketing is not a type. Right? So option number D is correct. Next question. Main purpose of customer due diligence is increasing customer loyalty, identifying and mitigate risk like money laundering, improve sales strategy, reduce documentation. So basically, what is the main purpose of CDD? The main purpose of CDD is, you identify, you migrate some risk like money laundering. CDD help bank prevent money laundering, terrorism financing, and any suspicious transaction. It is risk control and compliance process. It is not a sales process. Now, the next concept that we have is the due diligence process phases. So there are 6 phases of the process and some key things that bank must verify before giving the credit. So let's look at the due diligence process phase. So before a bank give any loan, it follows systematic and step-by-step process to verify the customer and then the business. This ensures that information is authentic and risk is under control. So the key idea is that, due diligence is not a single step. It involves multiple steps. It involves multiple phases, each giving more clarity about the borrower. So that's what I'm telling you, that due diligence is not a single step. It's involved, multiple phases. Right? And each giving more clarity. Each giving more clarity about customer. Right, please understand. So what are the 6 phases of due diligence? Let's have a look. The phases are, first of all, initial interaction. You initially interact. So these are the phases: initial interaction, data study, active evaluation, physical verification, data analysis, and report preparation. So let's simplify each step. So the first step is initial interaction. So what happened in the initial interaction? That meeting with the customer and basic information is collected. That is called initial interaction. Then we have data study. Data study means document is examined. Right. That's called initial check. Then active evaluation, which means financial, business, risk assessment. Financial, business, risk assessment is done. Physical verification, site visit, office, factory, shop inspection. Data analysis, comparing all the finding for consistency. Report preparation, finding, that's called final due diligence. Final due diligence. Right. Report prepare for decision making. So one example I can give you, that a bank officer verify PAN, check the civil report, conduct a site visit, and finally prepare a due diligence report. This is how it is done. So that is the process: initial interaction, data study, active evaluation, physical verification, data analysis, report preparation. Now the key verification in due diligence. So bank must check the customer identity, business background, financial credibility using authentic and official source. That is the point. Verify identity, verify financial credibility using official document and credit bureau data. So what are the things under verification? Like PAN verification, director identification number, DIN, credit bureau report like CRIF, high mark, market reputation check, fraud registry screening. You can see PAN, DIN, credit bureau report, market information, fraud registry screening. It ensures that loan goes into a genuine and trustworthy applicant only. That is what it ensures. All this process ensure that loan goes to genuine and trustworthy applicant. So I hope the rule is very clear. So what are the things under credit bureau? Credit bureau includes CRIF, high mark, civil. You might have heard the name of Experian. These are the credit bureau. You might have heard the name of Equifax. So these are the credit bureau, right? So one example I can give you. So master tip is that due diligence is 6 step plus multi-source verification. So master tip is that if you remember this line, 6 step plus multi-source verification, you will never forget the entire concept. That is what we have discussed right now. Verification source, we have PAN, DIN, credit bureau report, market information, fraud registry. So loan officer always check this CRIF, high mark, and civil before approving the credit. So the rules are very simple. That first rule is that due diligence means you interact. So that is the 6-step flow, and verification source. Just now I told you these are the official source, right? These are the official source that bank check before approving the credit. Now one question is, which of the following? So see, this is the point: interaction, that data study, evaluation, verification, analysis, report. So IDEVAR. Interaction, data, evaluation, verification, analysis, and report. So which of the following is not a phase of due diligence? Initial interaction is there, physical verification is there, marketing strategy is not there, report preparation is there. So this is not a phase of due diligence. IDVAR. This is a memory trick. You can remember the 6 phases of due diligence. Now, which credit bureau is used for due diligence? All of the above. Actually, CRIF, high mark, civil, Experian, all of them are used, right? So they use multiple credit bureau for checking the credit worthiness of the applicant. Now the next thing is informal data in due diligence. Formal data we have already seen. So basically, apart from the official document, bank also check informal or external data source, right, to confirm the authenticity of the borrower. The main point is confirming the authenticity of borrower. This is the main point. So these are not provided by the customer directly. The bank collect them independently. What are the sources from where bank collect? GST record, MCA website information, court judgment, newspaper and media report. So these are some informal source where bank collect the information like GST record, MCA website information, then we have the judgment, etc. So these help the bank identify the financial irregularities, dispute, or red flag. So the key idea is that, before sanctioning a loan, a pre-sanction unit visit by the credit officer is mandatory. So pre-sanction unit visit by the credit officer is mandatory. So the bank also evaluate the industry risk indicators. The bank also confirm DIN, that is called, director identification number for all the director. So bank also confirm director identification number for all the director. This ensure that the business is genuine and legally compliant. So pre-sanction unit visit is mandatory. Evaluate industry risk director and confirm DIN for all the director. So the simple formula is informal verification include GST, MCA, judgment, and news report. So a bank officer check the MCA website and GST filing before approving the credit. Now friends, the rest topic, the rest chapter we will discuss in our paid course. If you want to get access to that, you can watch 4 of CCP. And we are talking about the, unit number 5 of CCP. We are talking about the compliance and vigilance. So what does it mean? It means that bank must make sure that borrower is clean from legal and regulatory point of view. So borrower should be clean from legal and regulatory point of view. It includes confirming that customer is not listed on the, RBI caution list. They should not be listed on the RBI caution list, as you can see, or ECGC caution list, right, or defaulter list. That is what we mean by compliance and vigilance. So bank must also verify the management structure, right? So 2 things I am telling you. First of all, this should not be in the RBI or ECGC caution or defaulter list. Second thing is you have to verify the management structure to ensure that no hidden or no high risk individual are involved. So when I say management structure, it means, no hidden or high risk individual are involved. So the key idea is that, before sanctioning a loan, bank require independent certificate that all the government dues are fully paid. Independent certificate is required confirming all the government dues are fully paid. It includes PF, ESI, employee state insurance, SAN VAT, sales tax, income tax, labor dues, etc. etc. This ensures that the business is compliant and not violating any statutory obligation. So the rule is that, compliance check includes caution list, government dues, DIN verification, right? One example I can give you, that bank obtained certificate from company secretary confirming that all the dues are clear. So that is the point, compliance and vigilance, not in the RBI or ECGC caution list, and verify the management structure. So the rule is that informal verification include GST, MCA, and judgment and news, and compliance check include caution list, government dues plus DIN. These are included in the compliance list. Now let's apply the concept to some MCQs. Which of the following is an informal source for due diligence? GST record, PAN card, civil report, CRF high mark. See, the bottom 3 are the form, the bottom 3, just now I told you that the bottom 3 are the formal source, right? But this GST record, GST record, because GST record are checked from outside source to verify whether the borrower business activity looks genuine or not. So that is informal source. Next, role of fintech in due diligence. Let's talk about the role of fintech in due diligence. So, today bank don't rely only on manual check for due diligence. Modern banking have shifted to fintech power verification, which makes the entire process faster, smoother, and more accurate. So fintech company provide digital tools, right? Fintech company, they provide some digital tools. They also provide some APIs. They also provide SaaS platform that connect directly with the bank system. See, this is the fintech. You can think of it like this. This is the fintech company, and these company, what they provide? They provide digital tool, right? They provide APIs. They provide SaaS platform, so that connect directly with the bank system. It connect with the bank system, right? So this help them bank verify customer information instantly instead of waiting for days. This help verify the customer information directly instead of waiting for days. So let me give you one example to make it more clear. For example, instead of manually collecting document, bank can use fintech API to fetch financial data securely within seconds. So bank can use fintech API to fetch what? Financial to fetch financial data securely within second, and it improves the digital and mobile delivery of the services, and it reduces the paperwork, right? So how does it help? It help because it reduces the basically, instead of manually collecting document, bank can use fintech API to fetch financial data securely. It improves the digital and mobile delivery of services, and also paperwork get reduced. In simple word, we can say that fintech rule includes API integration, digital delivery plus secure data sharing. So API integration, digital delivery, data sharing, when combined together, it is equal to the fintech rule. So one example I have given you, that bank can use fintech API to pull customer financial data quickly and safely. Now let's look at the account aggregator framework. Right. So basically it started in the year September 2021 under RBI. Right. So the idea behind this framework is very simple: to make financial data sharing easy, secure, and customer control. Right. So why this account aggregated framework was started? To make financial data sharing easy. Right. Financial data sharing easy and secure, and customer control. So under this system, customer can allow bank or financial service provider to access their data with just a quick digital consent, right? So with just a quick digital consent, this make loan processing faster and increase financial inclusion, especially for those people who don't have traditional paperwork, right? So that is the account aggregator framework. So when it started, September 2021. So to make financial data sharing easy, secure, and customer control, and some key points they have mentioned, that there are 6 account aggregator who have been licensed by RBI, and 8 entities have with in principle approval. By August 2022, total of 22 major bank, including all the 12 PSB, joined the framework. So the system cover over 1 billion accounts, which shows how massive and how impactful it is, right? It shows how massive plus how impactful it is, right? So 6 account aggregator are fully licensed by RBI, 8 entities have in principle approval. By August 2022, total of 12 major bank, including all the 12 public sector bank, joined the framework. So it covers over 1 billion account, which shows how massive and how impactful it is. So the framework is basically, you can say, AA framework is equal to data sharing plus financial inclusion plus RBI regulated system. So let me give you one example. So with account aggregator, customer can share their bank statement data digitally. Customer can share their bank statement data digitally, and with just one click, they can share their data. So this is about aggregator framework. Sharing become easy, sharing becomes secure, and also customer centric. Now let's talk about the role of, we are just so one line example they have given. We have speed and transparency in due diligence. So fintech combined with account aggregator, we have speed plus transparency. So there are 2 rules. What are the 2 rules? The first one is the fintech role. Fintech role means API plus SaaS plus digital delivery, right? That is the fintech role. And what is AA framework? RBI license, data sharing, and inclusion. So these are the 2 rules. Fintech role includes API, SaaS, digital delivery, and AA framework means RBI license and data sharing and inclusion. So API means 3 things: access, process, and integrate. Access, process, and integrate. Now the question is, account aggregator framework was launched in which year? So please remember, account aggregator framework was launched in the year 2021. Option number C is correct. Next question, which technology enable fintech integration with bank? So the answer is API. API technology enable, API allow a third-party solution to integrate with bank platform. So option B is correct. So what we have just discussed, let me just summarize. That please understand, API plus account aggregator is equal to faster and smarter due diligence. Faster and smarter due diligence. Right. Please understand. So now let's talk about the so this topic I think we have already discussed. Let me just revise you once more. That what we have discussed here, that Fintech in due diligence means that bank now use technology-based tool to check customer information faster and more accurately. That is use of technology-driven solution. So instead of manual paperwork, bank use modern solution like SaaS platform. Bank use API, and also they use open development tools provided by fintech startup. This help bank deliver service digitally, whether through mobile app or through automated system, right? Through mobile app, through automated system. So in a nutshell, we can say due diligence include tech integration, data accessibility plus compliance. One example I have given you that bank use API to connect with fintech system and complete credit check within minutes instead of days. So for faster credit check within minutes, they can do faster credit check within minutes instead of days. That is the benefit of using API to integrate fintech solution. Account aggregator, I have already told you, this is an RBI approved system that allow customer to share their financial data securely with bank and financial service provider, but only with their consent. It was launched in September 2021. It also help increase financial inclusion, especially for people who may not have a long credit history. So one more thing is that by August 2022, 22 major banks joined AA framework. So what we have discussed that API plus account aggregator, faster, smarter due diligence. Now, so I think we have discussed these questions. Now the next concept is LEI. LEI stands for legal entity identifier. That's called LEI. So LEI is basically a 20-digit global identity number. You can see this is a 20-digit unique code, 20-digit global identity number given to companies and organizations that take part in the financial transaction. So this is a 20-digit unique code used to identify parties to financial transaction globally for better risk management. So 20-digit global identity number given to company. So please understand, LEI is given to companies. So those companies that take part in financial transaction. Think of it like an Aadhaar number, but for business, which is used worldwide to make financial system safer and more transparent. Right. So it make the financial system safer. It increase the transparency. Right. So that is the use of LEI. So this system was introduced after the global financial crisis. You can see it was introduced post global financial crisis because regulator realized that without a proper global ID for company, tracking risk become very difficult. Right. So that is what after the global financial crisis it was introduced. Why? The reason is very simple. That regulator realized that without a proper global ID, if you don't have a proper global ID for the companies, what will happen? Tracking risk become very difficult. So what LEI does, LEI improve the accuracy of the financial data and reduce big system risk. So two things it does. It improve the accuracy of the financial data and reduce the systemic risk. So the rule is very simple. LEI is mandatory for borrower who have a bank exposure of 5 crore and above. It is mandatory for borrower with exposure of 5 crore and above. Let me give you one example. Suppose there is a company. It has 10 crore exposure. So it must obtain an LEI by April 2024. So a company with 10 crore exposure must obtain LEI by April 2024. Right. Now we have RBI implementation schedule. So basically, this is the RBI phase timeline for LEI compliance. Phase timeline for LEI compliance. So RBI did not impose LEI all at once. Instead, it created a step-by-step schedule based on the exposure level. So this was a step-by-step schedule, and this schedule was based on the exposure level. So higher exposure has earlier deadline and lower exposure has later deadline. Please understand. Higher exposure have earlier deadline and lower exposure has the later deadline. So there is one important rule also. So first thing I told you that RBI phase timeline for LEI compliance, that RBI did not impose LEI all at once. It created a step-by-step schedule based on the exposure level. Higher exposure has earlier deadline and lower exposure has later one. There is one important rule also that if the borrower do not get LEI on time, the bank cannot give any new loan or renew the existing credit limit. That's why LEI was so much important, right? So borrower failing to obtain LEI cannot get new exposure or renew the existing limit. So the rule is there is a chart. In your book you will see a chart which they have given. So as you can see, exposure versus deadline. So on one side we have the deadline and on other side we have the exposure. So as you can see, exposure is 25 crore and above, means at least 25 crore. Deadline is 30 April 2023. Exposure is 10 to 25 crore. Deadline is 30 April 2024. Exposure is 5 to 10 crore. Deadline is 30 April 2025. Let's suppose, let me give you one example. For example, let's suppose that an borrower has 8 crore exposure. So what will be the deadline? So 8 crore exposure, their deadline will be April 2025 because it lie in this range, right? So that is how, based on the exposure, deadline has been decided. So the master tip is that LEI is the global identity for safer credit. Global identity for safe credit. So some rules they have mentioned that LEI code is how much digit? 20 digit unique identifier. So LEI is a 20 digit global identity number for companies. For what? For companies. Second point is compliance deadline, which is based on exposure slab. And I already told you, if exposure is higher, earlier deadline. As you can see, higher exposure, deadline is earlier. Lower exposure, deadline is later. Please understand. So compliance deadline based on exposure slab. So memory trick is that legal identity everywhere. This is a way you can remember it. Just remember this phrase and you will never forget what LEI stand for. Legal identity everywhere. Right? Or actually, it is legal identity identifier. Okay. Now let's do some MCQs. What is the minimum exposure for which LEI is mandatory? Tell me. The answer is 5 crore. Already I told you the minimum exposure for which LEI is mandatory is the 5 crore. Right? Please understand. I already told you that minimum exposure is 5 crore. And that is why in this case also you will see 5 to 10 crore April 30, 2025. 5 crore. Next question. Next question is, by what date should borrower with exposure above 25 crore obtain LEI? So it is higher exposure. So the deadline is 2023 April 30. Option C is correct. Now let's talk about the passport detail of borrower of public sector bank. So friends, let's start with the first concept. Back in the March 2018, back in the March 2018, the Ministry of Finance issued an advisory to all the public sector bank. So there was a directive issued by Ministry of Finance to the PSB. The directive says that for large loan case of 50 crore and above, see, when I say large loan case, it means, loan facility of 50 crore and above, bank must collect passport detail of all the key people. So passport detail was made mandatory for all the key people. Right? Who are the key people? So when I say key people, it includes promoters, it includes directors, and it includes authorized signatory. Right? So these are the key peoples. So what happened? Back in the March 2018, the Ministry of Finance issued an advisory to all the public sector bank. The directive says that for large loan case of 50 crore and above, bank must collect passport detail of all the key people. The purpose behind this rule is very simple. If needed, banks should be able to inform authority quickly, especially in cases where borrower might try to escape or avoid action. Right? So what was the reason behind it? Why this advisory was issued by the Ministry of Finance? That for large loan case of 50 crore and above, bank must collect passport detail of all the people. The purpose was very simple, that if needed, banks would be able to inform authority quickly, especially in case where borrower might try to escape or avoid action. So the basic formula is passport detail mandatory for loan above 50 crore and more. If a company takes 60 crore loan, it must submit certified copy of the promoter's passport. That's the point. Now, exception provision. Now let's understand the exception. What if promoter or director does not have passport at all? So if the concerned person does not have a passport, that is an exception. So in that case, the rule allows simple solution that the person can give a signed declaration. Right? They should give a signed declaration stating that they don't possess a passport. Right? So there is a signed declaration that we don't have a passport. So banks are allowed to accept this declaration instead of actual passport document. So the rule is that no passport, then in that case, declaration is accepted. Promoter without passport submit declaration instead. So master tip is that 50 crore loan, passport or declaration is a must. I hope it is clear. So the two rules we have just seen. So whenever a loan crosses 50 crore, the bank must collect the passport detail of the promoter and the director. Second point, if someone genuinely does not have a passport, a simple written declaration is enough. Third point, passport means proof of the big loan, which means just